All right, we're closing out another week. We've got 2 more chapters to go. We've done most of compensating differentials, which we did in the last video. All I need to do is kind of touch on the highlights that then in turn leads us into the next chapter, which is on taxes and employer-sponsored health insurance. So let's go ahead and get started. Remember, one of the key concepts in compensating differentials, it's a balancing act. Workers are paid what they're worth. So if you give them another benefit, you give them another perk, you're going to take something else away to kind of balance things out. Another important point to remember when you're talking about labor economics in terms of compensation is that compensation takes a lot of different forms. Yes, we've talked a lot about health insurance and workers' pay, but compensation could be more vacation time. It could be a 401k program that the company matches the employee dollar for dollar up to a certain percentage of their gross pay. It could be premium health insurance, or it could be something as simple as daycare. So if you remember from the chapter where the author talked a little bit about Miller's study in 2004, where Miller wanted to estimate the wage equation of the general form, if a company offered daycare or free daycare, that needs to be figured in the overall equation. I pulled this image to help you remember the concept or the implications of compensating differentials to make the employee whole again. So if you have health insurance and you decide to make the employees pay more in terms of co-pays, you're going to have to give something back in terms of more compensation, a different type of compensation to make them whole again. Compensating differentials can be a painful process both for the employee and the employer. It's a give and take by both parties. Alright, so now we're ready to drop into the next chapter, which deals with taxes and employer-sponsored health insurance. And if you remember back about taxes, and we talked a little bit about taxes previously, the driving force is that health insurance obtained through an employer is not subject to federal or state income tax, which is huge, or to Social Security or Medicare payroll taxes. So it's a win-win in terms of cost to the employee and the employer. So why do companies offer health insurance to their employees? Well, first, the workers value the coverage, and secondly, the employer can purchase the insurance a lot cheaper, and so there's tax benefits, there's favorable selection involved, because if an employee is working from an insurance standpoint, they're less apt to have claims than if they're unemployed. And why there's there reduction in cost? There's administrative cost savings compared to buying an individual health care plan. The tax treatment of health insurance for employer-sponsored health insurance helps to form the structure of the U.S. health insurance market. It also has an increased burden for taxpayers as a whole. So let's go ahead and take a look at some of these issues. And also remember, approximately 62% of those individuals in the United States under the age of 65 are covered in some shape or form by an employer-sponsored health care plan. The book has some supply and demand curves to give you a little better understanding of income and taxes and health insurance in comparison as far as hours of labor and then the price paid to employees. So the book goes on to discuss, in a competitive labor market with no taxes, and it looks at the equilibrium in the supply and demand curve at QE for the hours provided at a price, PE per hour, and it shows where that intersects. And then it adds an ad valorem tax. If you're not familiar with an ad valorem tax, it's a Latin word meaning according to value, and it's usually applied to real estate or personal property. But in this case, the book is using it as an ad valorem tax of 10% applied to the wage rate. So, as you can clearly see, this tax shifts the supply curve upward, and if you think about what we talked about in compensating differentials, now the people that are working, they have to get the wage that reflects the minimum acceptable wage and enough to cover the tax. This chart shows a typical tax structure, which shows the percentage based on different income levels. The first one is for a single, claiming one exemption, and the other one is a family filing jointly claiming 3 exemptions. And this can be a full-time job for someone in a corporate office or working for a large corporation. So let's go on to the next slide. You might want to follow along from the chart in your book as I go through this, but this is the how to figure a marginal tax rate for an individual, and they used a female in this particular case earning $45,000. She's taxed from a federal tax point at 25%, and then she's got to be taxed for a Social Security tax rate and a Medicare tax rate, and they've added that together. That's where they got the 7.65%. The employer has to match that at another 7.65, and then in this case, for whatever state she's at, it's a 5% tax. So her tax burden originally, her marginal tax rate is 32.65%. You add into the state rate along with that, and that is 37.65%. And so then they figured out the full marginal rate, and that's including the employer's contribution, and you can see the math that they did there to come up with 42%. So that could easily be a problem as far as one of the quiz problems. Let's just say I took family filing joint with 3 exceptions and they made $150,000. Figure that out. The effect of taxes. The book says that all but 6 states impose a state income tax. I'm reading out of a later edition textbook, but it's actually 7. But the point I want to make is a lot of people think that if a state doesn't have income tax, that's a better state to live in, and it's cheaper for me to live in. But you got to think, the state is going to get their revenue regardless, or they're going to get it from one way or another. So for example, Texas does not have the income tax, but Texas is one of the highest states in terms of property taxes. This slide shows that if an individual has to buy health insurance and pay the cost of it, by reducing their overall salary, they in turn then have to pay less taxes, so there's a savings. And when you have a savings, people are more likely to buy more insurance than they would otherwise have, because they've got that savings from a reduction of income, which then reduces their tax burden, so they can take the savings and buy more health insurance. This slide shows the other side of the street, from the government side. They call it tax expenditure. It's the term used to show and describe the tax revenue that's lost. So this is what happens when people shift their form of compensation. Okay, let's end up with something happy, like a room without a roof, or a flexible spending account. Anyway, so what is a flexible spending account? This is an account under the IRS section provision number 125, and what it does is it lets employers set up accounts for employees using pre-tax income. It goes into a special account held by the employer. The employee then can take these dollars for out-of-pocket medical expenses such as a dental visit or a copay visit, or prescriptions for that matter. But what does it do? It does make them happy. So it is a good deal, and everybody does like these plans, and they've been changing, and you'll see more of this in the upcoming news.
Clap along if you feel like a room without a roof. Clap along if you feel like happiness is the truth. Clap along if you know what happiness